Hey, welcome to Street.Smarts, where you learn what school forgot to teach you. Today, we're diving into compound interest, a powerful force that can turn small, steady savings into serious long-term growth. This single concept can literally change your life. So what is it? How does it work? And how can you start using it today? Let's break it down. What is compound interest? Compound interest is interest that's calculated on both your original investment and on the interest you've already earned. It means your money doesn't just grow, it starts growing on itself. Let's use some easy math to show you how this works. You deposit your initial investment, let's say $100. That's called your principal. You manage to park your money in an account that earns 10% per year. After 1 year, you earn $10 in interest. Now your balance is $110. In year 2, you earn 10% again, but now it's on $110, not just the original $100. That gives you $11 in interest. Now you've got $121. Each year, interest is added to your total, and every time that total grows, the next interest payment is based on the bigger number. You're not just earning interest, you're earning interest on your interest. This cycle keeps going. The longer you leave your money alone, the faster it grows. That's exponential growth, and it's what makes compound interest so powerful. And here's the kicker. If you keep adding more money along the way, even small amounts, your total grows even faster. Compound interest rewards both time and consistency. Bottom line, compound interest turns time into a money multiplier. Here are 3 easy ways to put compound interest to work. 1. High yield savings accounts, HYSAs. These are bank accounts, usually online, that work just like traditional savings accounts, but with way better interest rates. Instead of earning 0.42% like a regular bank, a good HYSA can give you around 4% right now. They're perfect for emergency funds or short-term savings. It's safe, low risk, and your money grows faster. Check out Ally, Marcus by Goldman Sachs, or SoFi, all solid options for high yield savings accounts. 2. Index funds. Index funds are baskets of stocks that track the entire market. You're not betting on one company, you're investing in hundreds at once. They typically return around 7 to 10% per year over the long term. And when you reinvest the dividends, compound interest really kicks in. Look at VTI from Vanguard, FXAIX from Fidelity, or SCHB from Schwab. And to actually invest in these index funds, you can open an account with Fidelity, Vanguard, Schwab, E-Trade, or use apps like Robinhood or M1 Finance. 3. Automated contributions. This one's the secret weapon. Set up auto deposits into your savings or investment account. Even $50 a month adds up fast. It removes the guesswork, builds the habit, and lets time do the heavy lifting. But the most important part, leave it alone. Don't pull money out unless you absolutely need it. Compound interest only works if you give it time. Now let's look at how compound interest plays out with some real life examples. In our first example, we have Taylor and Jordan use a high yield savings account earning 4% annually. Let's say Taylor starts investing early at age 20 and puts in $2,000 a year. They do this for just 15 years from age 20 to 35 and then stop. That's a total of $30,000 and they never add another dollar. Now let's look at Jordan. Jordan doesn't start investing until age 35. They contribute $2,000 every year from age 35 to 60. That's 25 years of investing for a total of $50,000. So who ends up with more at age 60? It's time versus money. Let's see it in action. Even though Taylor invested less and stopped completely at 35, their money had time to grow. She ends up with around $111,000. Now let's look at Jordan. Although she contributed more overall, starting later gave her money less time to grow, ending with around $86,000. Taylor put in less, started earlier, and walked away with more. She made $81,000 in interest. That's the time advantage in action. In our second example, it's traditional savings versus index funds. Now meet Mia and Chris, two 25-year-olds planning to retire at 60. They each commit to saving $300 every month. That's $3,600 a year for 35 years straight. No missed payments, no extra deposits. That's $126,000 total from each of them. But here's the difference. Mia parks her money in a traditional savings account, earning just 0.42% interest. Chris invests in a low-cost index fund, averaging 8% annual return. So what happens by age 60? It's traditional savings versus index funds. Let's run the numbers. Mia saved just as much as Chris, but parked it in a traditional savings account and ended up with only about $136,000. Even though Chris didn't invest a penny more than Mia, he made the smart move and put it in an index fund, stacking up close to $670,000. Let that sink in. Same monthly deposits, same time frame, same total invested. Chris walks away with over $500,000 more just by putting his money in the right place. He retires with $670,000. That's the power move. When your money's in the right spot, compound interest grows it exponentially. Now, technically, there's a formula for compound interest. It looks like this. But smart people don't bother doing the math by hand. They use a calculator, and I've got 3 solid beginner-friendly ones you can trust. No downloads, no signups, just plug and go. First up, we have investor.gov calculator. It's simple, ad-free, and built by the US government. It breaks down your money's growth year by year so you can clearly track your progress. Next up, the NerdWallet calculator, super visual and user-friendly. It shows your growth with colorful charts, lets you add monthly or yearly deposits, and makes it easy to see how consistent investing pays off over time. Also worth checking out the bank rate calculator. It lets you test different saving strategies side by side so you can see what actually works best for your goals. Every calculator needs input. Here's what you'll be asked to plug in. Just 4 simple things. Your investment. You can kick things off with a lump sum, set up recurring deposits, or do both. The interest rate is the percent your money earns each year, how often it compounds, usually annually or monthly, and how long you plan to keep it invested in years. Ready to run the numbers? All the tools and calculators we mentioned are linked below. Fast, easy, and yep, it helps support the channel too. Here's how a smart move turns into a missed opportunity, and it happens more than you'd think. They pull their money out way too early, killing the compounding before it has a chance to take off. They think they need to start big, so they wait and miss the window where time could have done the hard work. They get greedy, chase risky returns, or bounce from one investment to the next instead of letting a good strategy work. Or worst of all, they don't start at all. And that silence, that's the sound of compound interest never showing up. Don't be these people. Choose wisely, stick to the basics, stay consistent, and let time do the compounding for you. Compound interest doesn't just build wealth, it can bury you in debt if you're not careful. If you carry a credit card balance, you're not earning compound interest, you're paying it. Let's say you charge $1,000 to your card with a 20% interest rate and only make the minimum payments. It would take you around 9 years to pay it off, and you'd end up showing out over $2,500. That $1,000 purchase just cost you more than double. Lesson locked. Compound interest is a tool. Use it to build wealth, not to stay in debt. Real quick, everything in this video is for education and entertainment only. I'm not your financial advisor, doctor, or lawyer, so always do your own homework or talk to a pro before making big moves. That's a wrap. Today you learned what compound interest is, how it works, and why starting early and investing smart changes everything. Like, comment, and subscribe. Smart moves begin with you. Let your money and time handle the compounding. You learned it here, now put it to work. That's Street Smarts.